afternoon, everyone. Thank you for joining us for today's webinar on unrelated business taxable income. If you're attending this webinar to receive California CE credit, please note that if you meet the requirements, which I'll go over in a moment, that you'll receive an email within 3 business days with access to your certificate of completion. So just a few housekeeping items. You can maximize or minimize the webinar pane during the presentation by using the red arrow buttons. During the webinar, we also encourage you to ask questions. So you'll see a chat box that you can use to enter your questions. Just type your questions and click submit, and we'll either be able to answer them during the presentation or if we have time at the end of the presentation. Second, to ensure good audio quality, please check your settings to make sure the appropriate audio option is selected. If you're using a telephone, please click on the Use Telephone audio mode, or if you're listening through your computer, then please click on the Use Mic and Speakers option. Now I'd like to review a few things about California CE credits. You must use a personal computer, no PDAs, and log in with your own information and unique URL. You must be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. You must actively respond to at least 75% of the polling questions. There will be 4, so that means you have to respond to 3. And you must complete the evaluation survey at the end of the webinar. And now a quick introduction to our presenter, Lynn Henley, who is a nonprofit tax partner with Armanino. She has been providing consulting and compliance services for more than 18 years to a variety of tax-exempt organizations, including public charities, private foundations, supporting organizations, social welfare organizations, labor unions, social clubs, and business leagues. Lynn holds a master's degree in taxation from San Francisco State University and an undergraduate degree from UC Berkeley. She belongs to the American Institute of CPAs and the California Society of CPAs. And quickly, I'll go over the learning objectives for those of you who are looking for CE. So we will be reviewing today the UBTI history, framework, and definitions. We're going to be identifying unrelated business activities and running through some tangible examples. And we'll also be considering planning opportunities to minimize the related tax burden. And with that, I will turn it over to Lynn for a presentation overview.
Thank you, Debbie, and thanks to everyone for joining us today. A quick overview of what we're going to look at today, a very brief history, just 30 or 40 seconds on what this is all about. We're going to look a little bit more deeply into the 3 required characteristics of unrelated business income. We'll look at exceptions, modifications, how debt financing impacts these rules, and we're going to look at a bunch of examples. I know when I'm learning something, it always helps to have examples to apply that theory to our real lives. So for those of you who are pretty familiar with UBI, we're going to spend just 5 or so minutes on this introductory material, so hang in there with me. We'll get to some more complicated stuff. Okay, prior to 1950, tax-exempt organizations pretty much engaged in all manner of business to generate income for themselves. At that time, we were using a destination of income test to determine if income was related or unrelated. And what that meant was, as long as the organization used the income from whatever activity it was for their exempt purpose, everyone agreed that it shouldn't be taxed. Well, for-profit entities began to get a little tired of that because they felt like tax-exempt organizations who were doing the very same thing down the street and not paying tax as the for-profit entities were, that wasn't fair. So the for-profit guys went to Congress and complained, and then Congress responded with the UBI rules. Under these rules, 2 basic concepts. Activities unrelated to the exempt purpose must be segregated from the exempt activities, and if you have net income from unrelated business activities, you're going to be taxed like any other for-profit entity. So whether you're a corporation or a trust, you're going to be taxed accordingly. And just to reiterate, the purpose of these rules was to make sure that we didn't have some unfair taxation policies and that everybody's on a level playing field. So in order for income to be characterized as unrelated business income and taxed accordingly, it has to have 3 characteristics. It has to not be substantially related, or it has to be unrelated to the organization's exempt purpose. It has to be a trade or business, and it has to be regularly carried on. And bear in mind that this is an AND test, rather than an or test. So we have to have all three. If one of these is missing, no tax. So first we'll look at not substantially related. So going back to the beginning, exempt organizations are exempt from tax on revenue they generate by performing their exempt activity. Best examples, hospital. Patient fees paid to a hospital are exempt from taxation because that's the purpose of the hospitals, to cure the sick. Similarly with schools. When schools receive tuition, the tuition revenue is exempt from tax because the school's exempt purpose is to provide an education, and they get paid for doing that. And remember that ever since the new rules came into play, and I guess new is a relative term, that we don't look at the destination of the income. That is not a relevant factor. Where this mostly comes into play and where there's a lot of confusion out there is with fundraising activities. A lot of times folks will think that fundraising is somehow related to their exempt purpose because the income used from the fundraising activity supports what the organization does. And so that's not a good analysis. Remember that we always want to look at the activity itself when we determine if it's related to the organization's purpose. We're not going to look at the benefit derived therefrom. Your exempt application is an excellent source for reminding yourself about what the organization's exempt purpose is. So for C3s, that's going to be your Form 1023 application for exemption. So dig through that document. Let us know if you need some help. We'll help you dig through it. And the purpose for which you applied for exemption from the IRS will be in there. So that's probably the best source for looking at what your exempt purpose should be. For your C4s, 5s, 6s, etc., if you have filed a Form 1024, your purpose will be in there. And if not, take a look at your articles, and you'll get some guidance. So Debbie, I think that brings us to polling question number 1.
Thank you, Lynn. So as a reminder, if you're doing CE credit, you need to answer 3 of our 4 polling questions. And our first one is, which of the following are needed for income to be treated as unrelated business income? Is it A, the income must not be substantially related or unrelated to the organization's purpose? B, it must be a trade or business? C, it must be regularly carried on? Or D, all of the above? And while you're submitting your answers, I'll just remind you that we will be sending out the slides after the webinar. So as you're following along, take some notes, but we will get you these slides in the next day or 2. All right, and we'll close the polls in 3, 2, and 1. And I'll turn it back over to Lynn.
What a great group! We have I think that says 90% correct. Is that
81?
81% correct. Yep. Okay, so we have to have all 3 of those elements characteristic to the income in order for it to be taxed as unrelated business income. So good. So let's look at example number 1. And remember, in determining whether an activity is related or unrelated, we must ask ourselves whether the activity contributes importantly to the exempt purpose of the organization. So our private university X has a golf program, so students can take golf as part of their physical education program. X, the university, operates that golf course, and the golf course is used by students, faculty and staff, alumni of X, and the general public. Everyone pays green fees. The result of this is that the fees received from the students, faculty, and staff are going to be related income. The fees received from alumni and the general public are unrelated income, because then when you're allowing the alumni and general public to play on your course, you're like any other golf course. So that's a good example of related revenue versus unrelated revenue from the very same activity. And now we'll look at an example of trade or business income. So we still have X's golf course, but for the last 5 years, the expenses of operating the golf course have exceeded the income. So absent other facts and or circumstances, because there has been such a pattern of losses, there's a strong indication that University X's operation of the golf course is not a trade or business, because generally entities don't operate trade or businesses that just keep losing money. It happens, but for this purpose, it's not going to rise to the level of trade or business. So the result of this is that none of the fees received are going to be taxed as unrelated business income. Now let's talk about the folks that have two separate activities. One of them is an income generator, it's making good money, and then the other is unrelated and losing money. And over the years, the organization has used the operating losses from the second operation to offset the income from the first operation. So they kind of break even. The danger here is that the service may come in and say that the losing activity is not a trade or business, and so it cannot offset the income of the income generating activity. So be careful here. If you're trying to offset unrelated activities, make sure that both of those activities rise to the level of trade or business. I had a question from a school recently. They had a few t-shirts and other spirit-related items in a closet in the office. And occasionally someone would wander in and they'd want to buy a t-shirt or a hat or something. And the question came up, it's like, well, you know, selling clothing is not related to our exempt purpose, which is the delivery of education. But the reason that wasn't unrelated income is that selling a t-shirt out of a closet occasionally does not rise to the level of trade or business. Now you can see that at some point on the spectrum there would be a moment when the level of activity would sort of cross the line, and that's where it gets more difficult. So if you feel like you have an activity that's sort of creeping up on the whole trade or business characteristic, then it's time to take a little harder look at that activity. Regularly carried on. Now this is a source of a lot of conversations. So I think that one of the most important principles here when you're trying to determine if your activity is regularly carried on is, what is the normal time span of the activity? Best example is a Christmas tree lot. Kind of a classic example. So the normal time span of Christmas tree lots is a few weeks around November, December. Now your Christmas tree lot will also probably be operated in that same time span. So even though your activity is only carried on for a few weeks, because the normal time span of the Christmas tree lot is just a few weeks, then your activity will be deemed to be regularly carried on. It's going to be the same if you sell Valentine candy or anything else that has a quick time span. Intermittent activities in general. So, the t-shirts out of the closet, or, once in a while you have a carnival at the school, that kind of thing. Those are going to be intermittent activities. Again, not trade or business. And then your one-time events, like your fundraising gala every year. So if any of you have ever wondered, well, how come this isn't treated as unrelated business income? First of all, it's good news. And then secondly, it's because it's not regularly carried on. Now, if you were going to throw a party every week, then you'd probably have to look at that. And your board would probably all resign also, so we wouldn't want to do that. Really good case that addresses this topic is the NCAA case, the commissioner. I've given you the site here, and we're going to post it along with the webinar slides. And the reason I want to do that is for those of you that have sort of a deeper interest in this, the reasoning in that case is pretty well laid out, and it gives you both sides of the equation. It gives a nice write-up of the IRS's point of view and then the point of view of the NCAA. So what this basically came down to is the NCAA, they have a big basketball tournament every year, and they would sell advertising for that tournament. But it's a short time span. So, and yeah, there's a lot of prep work, but the actual sale of the advertising and then the delivery of the advertising itself during the tournament is a pretty short time span. The Internal Revenue Service came in and said, look, your normal time span of activity is this tournament. However long this tournament goes on, that's the normal time span. And since you are having advertising activities throughout that entire time span, then it's regularly carried on. The NCAA folks said, no, a basketball season is a lot longer than that. So we're not performing our advertising activities the whole time. And plus, the prep work for the advertising isn't included in the time that we're spending. So the NCAA folks prevailed in that case. And so it gives you an idea, if you read through it, what is normal and what is the whole, what's normal versus the time that you're taking. It's similar if you think about a sandwich shop, right? So the selling of the sandwiches, takes about 2 hours from 11:30 to 1:30. The preparation of the sandwiches might take all morning, but you don't have to include that morning prep time. Polling question number 2. Debbie?
Thank you, Lynn. So polling question number 2, which is going to review something that Lynn just talked about. So question is, when considering if a trade or business is regularly carried on, which items must be considered? Is it A, the time and planning of the activity, or the time involved in planning the activity, B, the normal time span of the activity, and C, the net income generated by the activity? So which is the correct answer? I'll give you a few seconds to input your response. And we'll close the polls in 3, 2, and 1. And I'll turn it back over to Lynn.
Clearly, our group has warmed up. We got a 95% correct response on that. So well done, group. We just needed to hit a few balls before we went out on the course today. So we've discussed that you need 3 characteristics in order to have unrelated business income. So that's our basis from which we begin. Then let's look at some exceptions. Now, Congress carved these out. It was probably as much to avoid consternation out there in the charity land as it was to keep a lot of things out of the courts. But in any case, there are exceptions to the UBI rules. First exception, volunteer exception. If your activity is entirely conducted by volunteers and entirely is not 100%, yet there is some wiggle room there. It's somewhere between substantial and entirely. Anyway, so entirely conducted by volunteers, you have an exception from UBI. There is a convenience exception. So if you think about the hospital and the cafeteria, the bookstore at the university, the cafeteria in the museum, those things allow patrons or employees to remain on site. And so it's for the convenience of the patrons. So those things aren't, the hospital isn't running the cafeteria to make money. They're running the cafeteria because doctors, nurses, people visiting patients need to have somewhere to go have a cup of coffee or to have a meal without leaving the hospital and wandering, aimlessly in the city streets. We also have a donations exception. If you're running, say, a thrift store and everything that you sell is a donated item, that's not going to be subject to UBI. There are similar exceptions for trade shows, certain bingo games, low-cost articles, the rental of mailing lists to other charities. So watch out for mailing list rental to non-charities. That gets more complicated. And also there's a special carve-out for a special kind of sponsorship payment called a qualified sponsorship payment. So those are exceptions. And in addition to the exceptions, we have items that are known as modifications. So before we talk about the modifications, I need to say 2 things. The first is that debt financing can change everything. So that's why it says unless debt financed, and it has that list of items there. So debt financing will change the rules around this kind of income. And the other thing is if you have a controlled subsidiary or if you are a controlled subsidiary, there are very special rules related to your situation. So these general rules won't entirely apply to you. They apply somewhat, but not entirely. So all that being said, unless there's debt financing, Congress has specifically carved out the income from dividends, interest, annuities, royalties, gains and losses from the sale of property, and rents of real property. And notice that I have there's different treatment for the rental of personal property. Personal property, you know, tables, chairs, silverware, that kind of thing. In the banquet context. So let's look a little bit at rents. So we're going to exclude all the properties, all the income from the rental of real property, and all the rental income from personal property if it's leased with the real property, if the rents attributable to the personal property are incidental. Okay, what does all that mean? So let's talk about you're an exempt organization and you have a hall. You have a big room and it can be used as a banquet space. And you also have tables and chairs. And as part of what you do, you're willing to rent that hall and the table and the chairs to anybody who wants to use your room, because you're not using it all the time and you're thinking to yourself, we could use the money. There are specific rules about rental from real property versus rental from personal property. So if the price paid for the rental of the real property and the personal property is entirely for the rental of real property, or if it is up to 20% attributable to the personal property, you can completely ignore the personal property rentals. Okay, so let's say your room rents for $100 and the personal property is going to cost 15 of those dollars. So $85 for the rental of the space, $15 for the rental of the tables and the chairs. You can completely ignore the $15 because it's less than 20%. Now, if the rental of the personal property represents anywhere from 20% to 50% of the entire cost, then you have to break your rental payment into two parts, one that is subject to UBIT and one that is not subject to UBIT. And if the rental of property, personal property, exceeds 50% of the total rent received, then the whole thing is going to be UBI. So I think the short story here is when you're structuring your contract about what someone is paying for, bear in mind that the rental of real property is excluded and the rental of personal property is more complicated. And just as a reminder, remember if there's debt financing on that property, the result may be very different. So let's talk about rent for a minute. Rent is a payment for the use of space. So if you start providing services, that's no longer the use of space. So if you think about when a hotel rents a room, that's not just going to be rent for the use of space. That's going to be a combination of the use of space and of services. So if you start providing those services, you fall out of that exclusion. So the numbers there on the rental of the real property versus the personal property are on this slide. And then the next item there that's an exception to the rental exclusion is if the rent is determined by net income or profits. Now, if you think about that, let's say that I'm renting a room and I tell the person that is going to rent my room, I say, you know what, I want 20% of your net income from whatever you're going to do in that space. You have sort of just gone into business with that person because now you're sharing in the net results of whatever activity that person is doing. And that's like being kind of a part owner. So the IRS has said that if that is your situation, if the profits from the enterprise are determining how much you receive, that's not going to be excluded from UBI. So that's going to be taxable. Now you can, however, structure your rental payment based on gross receipts because that's not like being in business with someone. So you can either have a flat fee or you can have your rent based on gross receipts. But the minute you base the rental that you receive on the income or profits of the activities, you have fallen out of the exclusion. We already talked about the rendering of services, and debt financing changes everything. So let's look at our private school conference facility. This is a pretty good example. I think it'll bring this home a little bit. So private school leases a conference facility to a for-profit entity, and that for-profit is going to do something that's not related to the school's educational purpose. Okay, so it's unrelated. 75% of the lease payment covers the use of the space, and 25% of the lease payment covers the use of the personal property. So our result here is that 75% payment is going to be excluded because it falls under the rental exclusion of real property, but that 25% for the personal property is going to be treated as unrelated business income. Now let's look at example number 4. So now we have a university basketball arena. So University Y, it's going to lease its basketball arena to a for-profit to use as a concert venue. And again, that concert does, in this case, does not contribute importantly to the educational activities of the university. In addition to renting the space, the university will provide utilities, security, and, here's the kicker, concessions. Now, because the university is providing services, particularly the concessions, it falls out of the rental exclusion and will be treated as UBI. Now, a little bit of note here, there are some rulings that indicate that the lessor may provide security and utilities and things of that nature, because the theory behind that is that if the lessor is providing security so that the building doesn't get trashed, then that's not a service being provided to the person who's renting. That's not a tenant service. That's a service that the lessor needs to provide in order to protect his interest, his or her interest. So we kind of ask ourselves, all right, who is this service for? Is it for the person renting, or is it for the person that is using that venue? Which I believe this brings us to polling question number 3. Debbie?
Thank you, Lynn. So I've got a little bit of setup here for this question, so give me a second to give you the scenario. So the restaurant at the local art museum serves the employees, the people visiting the museum, and the members of the public not visiting the museum. So the question, based on that scenario, is how can the museum avoid UBI from the sales to the general public? Can they A, hire a new chef? Can they B, lease to a third party and have that third party operate the restaurant? Can they C, ensure only museum employees work in the restaurant? Or D, you're not sure? Since we'll give everybody a few seconds to answer this question. And again, for those of you receiving or wanting to receive CE, you'll have to answer 3 out of our 4 questions, so jump in now. All right, and we'll probably close the poll in 3, 2, and 1. And I'll turn it back over to Lynn.
Thanks, Debbie. This was a hard one, and it assumes that there's no debt financing on the museum. But the correct answer here was that we wanted to lease the space to a third party and have the third party operate the restaurant, because what that does then means that the museum is receiving rental from the use of space, the use of real property, so that the museum is not in the restaurant business. The third party is in the restaurant business, but our museum is just receiving rental income, which is excluded. So good job. That was a tricky one. Now we're going to look at example 5. This is a cell tower rental. This comes up a lot. This is a standalone tower. So University X operates a radio station, and the activities are related to the university's exempt purpose. The transmission equipment is it's a standalone tower, so it's kind of sitting out on a piece of land by itself. There's no debt on the tower property, but under state law, the tower is not real property. So if it's not real property, this is personal property. So what we have here is that the result is that that rental income from the rental of the tower is going to be unrelated business income. And the key here is that you have to look under state law and find out what constitutes real property under your state law and what constitutes personal property. And then that will give you your answer. Because in this case, it's not real property. That was one of the stated facts. Example number 6. All right, University X still operating that radio station. Activities are related to the university's exempt purpose. They must have a broadcasting major. The tower sits on top of a dormitory. There's no debt on the tower property. And in this case, the tower is part of the building and as such is real property. So our result here is that the rental from that tower is not unrelated business income. So now we have L. L is a public university, and it's going to lease property to a telephone company, and the telephone company is going to erect a tower. L will not provide any services, and the telephone company builds the tower and pays all the expenses. And our result here is that the rental income to L is not unrelated business income because all L is doing is leasing property. The next item we have here is right out of a revenue ruling 76402. So we have an exempt educational institution. It's annually contracts with an individual who conducts a summer tennis camp on the school facilities. So now we have facilities at our school that have a dual use. Sometimes it's used for the summer tennis camp and sometimes it's used for students. So you're going to allocate any income that's generated from the rental of the tennis facilities between the income that's related to the school's purpose. In other words, if the school has a tennis program as part of its educational program, then that's going to be related to the school's activity. And if it's just a summer tennis camp for anybody who wants to come but not related to the school's activities, then that is going to be unrelated business income. And now let's look at example 8, which is a university hotel operation. And there's a couple of these hotel examples just because I wanted to draw a contrast and how a particular set of facts can impact the result. So University X operates a hotel. And it's to house visiting professors, parents, visiting athletes, and other university guests. Now this hotel is also open to the public. And it's important to note that there are other places to stay in the area. This is not in the middle of the Arctic. So the result here is that the income University X receives from providing the rooms to the professors, parents, visiting athletes, university guests, who contribute importantly to the university, that's related income and won't be subject to unrelated business tax. But the income from the general public does not contribute importantly to X's exempt purpose and is therefore unrelated business income. Okay, now here's the contrasting example, example 9. Same university, but now we have a hotel management program as part of the curriculum at the university. So we have the same people coming. It's the visiting professors and the athletes and the guests and the general public, and there's still other hotels in the area. But now, because there's a hotel management program, the income received from the operation of the hotel rent, and when those rooms are rented to anyone, including the general public, now that's going to be related to its exempt purpose and not subject to unrelated business income. Okay, let's look at some food service. So University X is going to contract with an outside company to provide the food service in its various housing facilities. And X doesn't provide any other services to the tenants. So we're not talking about dorms here. These are just outside housing facilities. And X rents rooms to students, faculty, and unrelated organizations. The key here is that University X does not have unrelated income from the rental of these facilities because the food services are provided by a third party, so that X is not drawn into the food service business. Debbie, I think we have our next polling question.
Thank you, Lynn. So this will be our fourth and final polling question for the webinar. And the question is, which of the following will be needed in order to know how to determine if rent from a cell tower will be treated as UBI, unrelated business income? Is the answer A, under state law, is a cell tower treated as real property? B, who owns the cell tower? C, is the property debt financed? Or D, all of the above? Or E, you're not sure. And as a reminder to those of you who are absorbing all of this, there's a lot of great examples that Lynn is going through. And again, I will be sending out the slide deck after the webinar. So take some notes, but you don't have to scramble it all down. And we'll plan to close the polls in a few seconds. We'll close in about 3, 2, and 1. And I'll turn it back over to Lynn.
Thanks, Debbie. That looks great. Yeah, all of the above is the best answer there. This wasn't cut and dried. It's a little bit tricky, but yes, D would be the best answer there. So thank you all very much. So we go on to a couple of additional examples. So we still have we have some university hotel operations. We got food service and rental of space. Okay, so let's look at this. University X is still, renting housing facilities around town. And now the university itself is providing food service along with the rental of space. And X rents rooms to students, faculties, and unrelated organizations for events. So our result here is that the income from the students and faculty is not unrelated income, meaning that it is related income. Because it's related to the university's purpose, because of the students and the faculty. Conversely, the income to the unrelated, or the income from the unrelated organizations is UBI, because the university is providing substantial services. So in other words, this is not just for the rental of space. Now we're providing food service. So we fall out of the rental exclusion. So that's a pretty good example. So the next thing I wanted to talk to you about is the allocation of rental expenses against unrelated business income. Our landmark case out there is Rensselaer Polytechnic. In Rensselaer, the taxpayer separated its rental expenses into 3 parts. The first part was the direct expenses. Right, so those would be the expenses that, but for engaging in the activity, those expenses would not have existed. It's like cost of goods sold is a pretty good way to think about direct expenses. Next category was variable expenses. Those are the expenses that increased because of some rental activities at the Institute. And then the third category where the controversy arose was in the allocation of fixed expenses against the rental income. So fixed expenses that aren't going to be impacted by the level of use, depreciation, property taxes, items that continue whether you're using the space or not. The services position was that in order to know the level of fixed expenses to allocate against UBI is that you would take the fixed expenses, total fixed expenses of the organization, and then multiply that by a fraction. And the numerator of that fraction needed to be total unrelated business hours over total available hours. So in that fraction, you will see that the total available hours number is going to be quite large. Rensselaer, the taxpayer, said, no, we think that it should be fixed expenses multiplied by, yes, total UBI hours, but we think it should be divided by the total hours used, not total hours available. And so what happened is that Rensselaer prevailed, and the allocation of fixed expenses that Rensselaer wanted was higher than the allocation that the IRS wanted. So when you're thinking about allocating expenses against your unrelated business income, you can follow the Rensselaer model. Understand that the IRS does not like this result, but that's the word of the courts. Sometimes when you're dealing with the IRS, there's some confusion about the difference between the Internal Revenue Manual and the Internal Revenue Code. I would suggest to you that the Internal Revenue Code is actually the law. Royalties. So when you're structuring your contract for royalties, remember that royalty income will not be unrelated business income as long as you meet the statutory definition of a royalty. And that's going to be the payment for the use of your name is a really good example. But when you start engaging in activities and start going into business with the person that's paying you the royalty, that can cause you to fall out of that royalty exception. Great example, T-shirts. Okay, let's say you have a charity that has a great reputation, and someone comes to you and says, look, I want to produce T-shirts, and I want to use your name somehow on that T-shirt. So if they are going to pay you, and they say to you, you don't have to do anything, I just want to use your name. Great, that's a royalty. If, however, they say to you, I want to use your name on the T-shirt, and I want you to help us design the T-shirts and help us coordinate who's going to get the T-shirts and how they'll be printed, and I want you to have input on a monthly basis, then all of a sudden they have turned this in from a royalty to something else. So watch out for providing extensive services in a royalty contract. The next item that we want to talk about is advertising, and then as sort of a subset of that conversation, we want to talk about qualified sponsorships. This comes up a lot. So let's start at an easy place where we just say generally advertising, the income from advertising is unrelated business income. And remember that among other things, advertising contains qualitative or comparative language, an inducement to buy, etc. There is a specific carve-out for something called a qualified sponsorship payment. And Congress has said that if you meet the definition of a qualified sponsorship payment, the revenue from that payment is not going to be treated as unrelated business income. QSPs may be thought of as a safe harbor. This came out of there was a mobile cotton bowl, and mobile was, paying the cotton bowl folks to advertise and get their name all over the place. And the service came in and said, you know what, all of that is income to you, cotton bowl people. And because of that holding, everyone in the exempt sector was very frightened that corporations would stop sponsoring their activities, and that all these organizations would now have taxable income from that sponsorship. So folks went to Congress and said, look, you have to do something, and Congress did. So they created this specific carve-out. So you'll see there's the new Treasury regulations. It's Code 513, and sort of the Treasury Regs 1.513. A QSP is any payment with respect to which there's no arrangement or expectation that the person making the payment will receive any, quote, substantial return benefit. You're like, okay, great, but what is a substantial return benefit? So first of all, we know that a mere acknowledgement, like Catherine and John D. MacArthur Foundation, proud sponsor of X, that's an acknowledgement, and that is not going to be considered a substantial return benefit. So something like that does qualify under the qualified sponsorship payment definition. Okay, so that's not going to be subject to UBI. By contrast, if you have advertising or an exclusive provider arrangement, or your organization is providing goods, services, facilities, or something else to the person making the payment, then you might find yourself in the second test for whether you qualify as whether the payment qualifies as a qualified sponsorship payment. So to put this sort of more succinctly, if the person making the payment receives more than 2% in value of what he or she or it paid to you, then that's going to be a substantial return benefit. And it's not going to be a qualified sponsorship payment. So I think that the easiest way to illustrate this is let's look at this university and drink company example. I think that's going to be a pretty good example. So University X enters into a 10-year contract with this sports company, and the sports company, under their contract, they're like, we want to be the exclusive provider of all your sports drinks, and we want our name everywhere. And when people are sitting down on the sidelines, on the bench, the cooler is going to have our name on it, and all that stuff. And nobody else can provide sports drinks. In addition, the university agrees it's going to provide some services for the sports drink company. The coaches are going to make personal appearances, and the coaches will assist with marketing plans for the sports drink, etc. What this is going to result in is that due to the services performed by X and the exclusive provider arrangement, that income received by the university, it's not going to qualify as a royalty because there's too many services. It's not going to be a QSP because the value received by the sports drink company, it exceeds 2% of their payment. So this is going to be treated as unrelated business income. A quick note here, when you're structuring these contracts, note that there is a difference between an exclusive provider arrangement and an exclusive sponsor arrangement. So quickly, an exclusive sponsor, okay, this is an arrangement that acknowledges the payor as the exclusive sponsor of an activity, right? So you can say, our gala is exclusively sponsored by X Corporation tonight. Generally, that's not going to result in a substantial return benefit, and you'll still fall within the qualified sponsorship payment exclusion. By way of contrast, if you're an exclusive provider, this is an arrangement that limits the sale, distribution, availability, or use of competing products. So let's say that famous soft drink manufacturer P comes to you and says, I want to sponsor your activity, but do not sell the cola beverage from soft drink manufacturer C. You can only sell the P drinks. Then we have an exclusive provider arrangement, and that is generally going to result in a substantial return benefit because you're eliminating the competition, and that's going to fall outside the realm of a qualified sponsorship payment. So just be aware, when you're structuring these contracts that there are differences, and they may seem, on the face of them, they may seem pretty innocuous, but can make all the difference. So let's look at another example here. Example 13 and 14 I think also will serve to bring this home. So we have a charity that organizes a marathon, walkathon. This corporation comes in and pays for the food, the drinks, the t-shirts, the hats, the banners, everything. They name the event after the corporation, but the corporation receives nothing else. So that's going to be a qualified sponsorship payment because the corporation received only an acknowledgement, and that is not a substantial return benefit. So now let's look at example 14. Now, in this case, our corporation has funded an exhibit at an art museum. And, you know, on the museum's website and public publicity materials and a couple signs in the museum, we have the corporation's name. Okay, proud sponsor of the exhibit. In addition, the museum treats the corporation's executive to dinner, the executives to dinner. And the fair market value of that dinner exceeds 2% of the payment that the corporation made to the museum. Because that fair market value of the dinner exceeded the 2%, that dinner creates a substantial return benefit. So then what you have to do is divide that payment into two parts. It's the portion of the payment that the museum can demonstrate exceeds the value of the dinner. That's going to be your qualified sponsorship payment and not subject to UBI. The other part of the payment that is equal to the fair market value of the dinner will be treated as unrelated business income. So hopefully between those three examples, that sort of helps with the qualified sponsorship payment. Websites and hyperlinks. Hyperlinks links, that's interesting. So I think a lot of websites have hyperlinks to their sponsors' websites. And we just need to be a little bit careful here that we don't inadvertently create some UBI for our organization. And as an aside, while we're on the topic, I just want to mention to you, watch out for links to anyone that has political activity on their website, because that can be a real problem and you didn't even mean to do it. So on your charity or exempt organization's website, you are perfectly welcome and encouraged to post a list of sponsors. And you can even have hyperlinks to the sponsor's website. When you run into a problem is that once at the sponsor's website, if your exempt organization endorses somehow your sponsor's product, then all of a sudden that could be unrelated business income from advertising. And that would not be a qualified sponsorship payment. So watch out for those links. Again, it's perfectly acceptable to have a link to your sponsor's website. Go ahead and click on that link and see what happens when you get there. Is it, if you are, you know, someone who has just gone through that process, and when you land on the other side of that link, if you feel like you are being sold something and that the exempt organization is participating in that process, you could very well have advertising. So this is not a black and white area, and a lot of it is still going to intent, which is is highly subjective. But the more we avoid any question, the easier our lives are. And remember that when you're considering if something you're doing on your website is advertising, sometimes it helps to think about, gosh, in the old brick and mortar days or the old print material days, what would the result have been? And a lot of times you can apply those same rules and get your answer by sort of backing up and not thinking of the internet as something that is new and different. It's just an extension of the things we already had. Travel and tour activities. A lot of times an exempt organization will have a travel and tour activity. If that tour is substantially related to the organization's exempt purpose, then you're not going to have UBI because you have related activities. If that travel tour is not substantially related, you could very well have UBI. So there's lots of good examples out there in revenue rulings. So one of the best examples, we have a university travel tour company. And when people go on these tours, they spend 5 to 6 hours with a guide who is well versed in the culture and history of wherever they're visiting. They have a test occasionally, and there's a real attempt to make it an educational event. So that tour could very well be treated as a related activity. Conversely, if our travel tour is we're going all together, we've rented the hotel, you're on your own for a couple days, we meet in the morning for a quick lecture and showing you the map of the area, and then we just have fun for the rest of the day, it's going to be harder to prove that that travel tour is related to the exempt purpose of the organization. So this is a facts and circumstances analysis. If you have travel and tour activities and you're contemplating those, just let us know. We could share with you the various rulings and the examples from the Treasury regs. You'll see there it's 513-7B, excellent examples about what qualifies as a related tour. So just let us know and we can help you with that. We've talked about pass-through investments in the past. Watch out for S-corps. Any income from an S-corp that you're invested in is going to be UBI, and it doesn't even matter if in the initial analysis it would have been related to you or not. Just the fact that it's S-corp income is going to be UBI. And remember that the K-1 items are going to retain their character, right? So if some of that partnership income is debt financed, when that comes to you, that's going to be debt financed income. So watch out for that. Also, ordinary income from those partnerships, unless that's related to your exempt purpose, that's going to give you unrelated business income. So I see, and there's some resources there. I see that we have quite a few questions. I will absolutely address those offline because I've talked too much today, but appreciate your attention and being here with us today, and hope you've enjoyed it.
Thank you, Lynn. So in summary, during today's webinar, we've covered the history, framework, and some definitions of unrelated business income. We've reviewed multiple examples and some really just great tangible examples of unrelated business activities with respect to your type of organization, your nonprofits. And we've also discussed planning opportunities to minimize the related tax burden. As Lynn mentioned, we've got a couple of questions here, but because we are running short on time, I'll make sure that she gets them and that she addresses them after the webinar. And with that, if you have any additional questions that you didn't get a chance to ask, please do submit them to Lynn. Her email and her phone are here, or when you receive my email with the slides, feel free to reply to me, and we'll be happy to get back with you. So thank you again for joining us, and we hope to see you at an upcoming webinar. Thank you so much.